Preparing a Sustainability Report, Part 3 of 5. Welcome. The Sustainability Report is an important tool to help an organization communicate effectively with its stakeholders. In this course, you will learn about sustainability reporting, Singapore Exchange's Sustainability Reporting Guide, and how to implement the guide in practice. The course starts with providing you an understanding of corporate sustainability. The course will then take you through a step-by-step approach from planning to developing a sustainability report. You may access the SGX's Sustainability Reporting Guide on the link provided on the screen for more details. There are 5 topics in this course which will take approximately 90 minutes to complete. You can access any of these topics in the Preparing a Sustainability Report playlist available on the SGX Group channel. Topic 3: Materiality and Stakeholder Engagement. Welcome to Topic 3: Materiality and Stakeholder Engagement. This topic provides an overview of the concept of materiality and elaborates on the process of identifying an organization's material, environmental, social, and governance factors and stakeholder engagement. As guidance, sustainability reporting relates to the most important environmental, social, and governance risks and opportunities that will act as barriers or enablers to achieving business goals in the short, medium, and long term. In assessing materiality of the ESG factors on which an organization reports, the organization should first satisfy itself of the relevance of selected factors to its business strategy and outcomes. The concept of materiality enables an organization to identify the most important ESG factors for sustainability reporting, report on ESG factors that are relevant to stakeholders and of significance to the business, focus on measuring and therefore managing relevant sustainability performance aspects. Do not shy away from quantitative metrics or measuring metrics quantitatively, as the data is likely to yield improvement for better management and provide assurance that what is of key importance to sustaining the businesses of the company is properly managed. A building blocks approach could provide a consistent and comparable baseline of sustainability-related information that could be material to investors' decisions because of the impact on enterprise value creation, while also providing flexibility for coordination on reporting requirements that capture other sustainability interests and objectives and serve wider stakeholders. Sustainability building blocks, Block 1, enables enterprise value reporting for investors' other providers of financial capital. Identifies those sustainability factors material to short, medium, long-term enterprise value. Establishes a consistent baseline of assurable information for investors in global capital markets, i.e., through standards to be set by an IFRS International Sustainability Standards Board, ISSB. Includes qualitative information about governance, strategy, and risk management of material sustainability factors, includes performance targets and quantitative metrics for material sustainability factors, both cross-industry, for example, similar to WEF core metrics, and industry-specific, for example, similar to SASB. Block 2 enables multi-stakeholder reporting on sustainable development, captures impacts of a reporting entity on economy, environment, and people that are not already in Block 1, may be required by jurisdictions in support of the UN SDGs or specific public policy objectives, for example, the EU Green Deal, could be globally applicable standards or guidance, using widely accepted sustainability reporting standards such as GRI, and/or jurisdiction-specific requirements. The GRI Sustainability Framework also provides guidance on materiality. GRI encourages organizations to identify material topics by considering 2 dimensions of the principle: the significance of the organization's economic, environmental, and social impacts, and their substantive influence on the assessments and decisions of stakeholders. In order to report in accordance with the GRI standards, organizations are required to determine its material topics. An organization may use the materiality determination process to determine its material ESG factors. First, identify a list of potential material ESG factors. Second, rate the ESG factors identified based on relevance to the organization. Third, prioritize the material factors based on likelihood and impact to the business. Fourth, Validate the prioritized factors internally and seek sign-off from the board. Underpinning the materiality assessment process is stakeholder engagement. Stakeholder engagement is the process by which an organization connects with stakeholders with the purpose of achieving agreed outcomes. It is also a fundamental accountability mechanism. An organization should involve stakeholders in identifying, understanding, and responding to sustainability issues and concerns, and report and explain its decisions, actions, and performance to them. A robust stakeholder engagement process can result in better risk management, improved reputation, and process improvements and innovations. Identify a list of potential material ESG factors. To identify the potential list of material ESG factors, it is important to take both external and internal indicators of an organization into consideration in this step. Examples of external indicators are environmental impacts, social impacts, laws and regulations, and peers and industry norms. Internal indicators include business model and strategy, value drivers, enterprise risks, and organizational policies. The significance of the ESG factors to the business may vary depending on the industry and sector of the organization. An organization may make reference to reporting frameworks such as GRI's sector standards and SASB's materiality map to identify sustainability issues that are likely to impact the financial condition or operating performance of companies within an industry. Rate the ESG factors identified based on relevance to organization. There might be a myriad of ESG factors that are potentially relevant to the organization. An organization will need to assess whether the factors are pervasive across the organization's business lines and subsidiaries. To determine the relevance, an organization may cluster similar ESG issues together. For example, safety and health issues can be grouped together. Then, determine if the factors are relevant to the organization's various business lines and subsidiaries that have been included in the scope of reporting. Through this process, the organization will be able to refine and further shortlist the potential material ESG factors. An organization may have a long list of ESG factors after the rating process. It is important to have a mechanism to prioritize the ESG factors. An organization may consider likelihood and impact in prioritizing the ESG factors. The ESG factors to be disclosed in the sustainability report should be those that are highly relevant to the organization's stakeholders and significant to the business. Validate, seek sign-off from the board. Once the ESG factors have been prioritized, the organization can seek internal validation and sign-off from the board as a form of acknowledgement that the ESG factors are relevant and material to the business. It's time for a quick knowledge check. How can the concept of materiality help an organization in sustainability reporting? Select the correct statements. You may pause the video now, jot down the answers, and when you are ready to continue, press play. The correct answers are: first, materiality enables an organization to identify the most important ESG factors for sustainability reporting, and second, it also helps the organization to focus on measuring and managing the performance of the ESG factors identified. Congratulations! You have completed Part 3 of 5 of the course on preparing a sustainability report. You may access the 4th module on data collection and targets from the playlist available on the SGX Group channel.